Hello, I'm Mike Hayes, editor of International Construction magazine.
And I'm Joe Malone, deputy editor. This video was produced by International Construction, part of the KHL Group. Visit www.khl.com for more.
In this video, we'll take a quick look at the global construction market, highlighting some of the interesting areas of growth and hopefully giving some insight into the direction the market is set to take over the next 12 months and beyond. We've drawn on various data sources for the information in this report, much of which is available on the khl.com website in PDF versions of the magazine, online news stories, podcasts and videos. As an overview, the construction industry globally is forecast to grow 3.9% per annum between 2016 and 2020. At the end of this forecast period, emerging markets are expected to overtake mature markets to represent a 56% share of the industry's total value. And they'll do that by growing at 5.3% per annum, compared with growth of only 2.2% per annum in more mature markets. The biggest growth markets in the run-up to 2020 are set to be those in the Asia Pacific region and in the Middle East. And in terms of average growth this year, Asia Pacific is expected to grow 7.1%, which compares pretty favourably with a global average of 2.5%. Drilling down into that figure, we see there's huge planned investment in, for example, airports and road and rail infrastructure, with much of the financing for projects coming from China, which is driving ahead with plans for its One Belt, One Road initiative. In the past year, for example, we've reported on significant Chinese investment in projects in countries such as Thailand, Laos, Singapore and Malaysia. In the June issue of International Construction, we featured what I call a bubble chart, which nicely demonstrates the risk-reward dilemma for construction firms looking at projects in the Asia Pacific region, with higher risk markets such as Sri Lanka and Indonesia also showing some of the strongest growth. As you can see, Singapore is sitting in the enviable position of being low risk and showing generally relatively solid growth. No surprise then that it remains at the top of the Global Infrastructure Index produced by industry consultancy Arcadis. This really useful index measures countries by their attractiveness to investors in infrastructure against criteria such as tax regimes, the quality of their infrastructure and risk profiles.
In second and third place respectively on the Infrastructure Index are Qatar and the UAE. In general, the Middle East region is moving well ahead of global growth figures and driving forward with some significant projects. Construction spend is forecast to increase by 4.5% between now and 2020. That said, while nations such as the UAE, Saudi Arabia and Qatar can progress with quite impressive development of their infrastructure, low oil prices are putting pressure on nations within the region that don't have such large war chests. Furthermore, the risk of socio-political unrest in some countries is likely to keep a lid on significant inward investment outside the so-called safe haven countries. In terms of the countries to keep an eye on, Iran has to be top of that list, with the lifting of the economic sanctions that have been stifling trade there to a greater or lesser extent since 1979. Energy and infrastructure projects are already in the offing, and while the risks are still relatively high, the potential rewards are clear. Analyst Off-Highway Research recently released a 160-page report on the potential of Iran as a construction market, and it can be purchased through the khl.com website. Dubai is another market that constantly rewrites the rulebook on boom and bust, and it's currently gearing up for its infrastructure to cope with a huge uplift in tourism as it prepares to host the World Expo event in 2020. Similarly, Qatar is developing stadia, hotels and transport networks ahead of its hosting of the FIFA World Cup of Football in 2022.
The direction of the market in the US is a harder one to judge, especially following the recent unexpected victory of Donald Trump in the presidential elections. When President Obama pushed through the highways bill in December last year, the potential for more than $300 billion being released to construction seemed set to push the market forward. Yet growth continues to be relatively weak, possibly due to a national intake of breath over the presidential election. Now, that's behind us. We wait to see whether Mr. Trump's promises about rebuilding the country's infrastructure were meaningful or just political rhetoric. Meanwhile, construction costs continue to grow with a combination of increased labour and materials costs. We've recently reported on a glut of second-hand equipment on the US market, and the construction industry bellwether Caterpillar has been cutting its manufacturing capacity to align with lower demand. Residential construction is certainly on the up in the States, as we see last year's 1.1 million housing starts turn into 1.2 million this year. But we're unlikely to see the healthy 1.5 million starts before 2018.
We get an equally mixed picture when we look at Europe, but Northern Europe is tending to lead the way, at least in non-residential construction. As a quick snapshot of the market, the forecast is for compound annual growth rate over the next 5 years of 3.6% in Ireland, 3.1% in the Netherlands, 3% in the UK, then we have Denmark at 2.9% and Sweden at 2.5%. Obviously, prospects for the UK construction markets are looking a little less bright following Brexit, although it's hard to determine at this point how much of a downturn is Brexit and how much was coming anyway. According to an off-highway research report, sales of construction equipment will be 10% lower this year than in 2015. This is a 2% drop from the firm's pre-Brexit forecast. Good news comes from Spain, however, where the non-residential sector is finally set to recover, with 3% compound annual growth forecast through to 2019.
The good news for the Indian construction industry is that Prime Minister Narendra Modi has made the development of road, rail and other transport infrastructure a priority since coming to power in 2014. The bad news, as Nibadab Mohanty of the Institute for Studies in Industrial Development in Delhi recently said, is India is a difficult place to govern and one needs to have patience. While the outlook is still positive, India's most recent data indicate a loss of momentum, with a sharp slowdown in fixed investment activity dragging on growth. The government's most recent budget allocated the equivalent of $32 billion to infrastructure development in full year 2016 to 2017, 3 times that of the previous year. The biggest chunk of budget is earmarked for roads and highway development, as well as railways, the aviation sector, and the development of greenfield ports for commercial shipping.
In China, while the economy is far from rosy given its current growth model, the country's built asset stock will nonetheless be worth more than double that of the US by 2025. While the decline in construction output growth has hit construction equipment manufacturers hard, there does appear to be light at the end of the tunnel. For one thing, the Chinese government's revision of the one-child policy will, in the long term, aid construction growth. This, combined with a package of construction projects equivalent to around $1 trillion, should breathe some life into the market. At the beginning of this year, Shanghai Securities News reported that 9 provinces had released their investment projects for 2016, and the combined investment from them totaled over 14 trillion renminbi, or $2.1 trillion. Most of the major projects are infrastructure, including water, transportation and energy. However, some provinces cut investment from 2015, largely because of the fiscal shortage of local governments. Local debt pressure, limitations on government finance vehicles, as well as declining tax revenue in the recession, worsen the local government's investment ability. That suggests limited infrastructure expansion to soften the slowdown in 2016 compared with 2015. Although it does not mean shrinking fiscal stimulus. In fact, the expectation is that by the end of the year, China will have expanded its fiscal deficit.
Okay, so that's a quick look at some of the important global markets for construction. In the next video, we plan to examine more closely a number of interesting markets in Latin America and Africa, and perhaps try and drill down into the tricky risk-reward equations in those markets. Until then, thanks for watching.